Hi, everybody, and welcome back to video number 7 in chapter 22. And when we left off, we were looking at Ann Johnson receiving some options. And we're going to take a look at what are the journal entries that First Wave would make in recording the first year's stock options. And here, the compensation expense is going to be half of $200,000, the fair value of the options. We divide it in two because she's going to have that over 2 years. And the credit will be to paid in capital dash stock options here. In addition, if we assume that First Wave has a 20% tax rate, which is given in the problem here, it would recognize a deferred tax asset of $20,000. That's $100,000 times 20% in the first year as follows. So we'll debit deferred tax asset here for $20,000 and credit income tax expense for $20,000. So for number Bravo, how would the stock options be reported on the statement of cash flows in the first year? We would show net income of $600,000 here, and we would have adjustments to reconcile net income to net cash provided by operating activities, and we would add the share-based compensation expense of $100,000, and we would deduct the increase in the deferred tax asset of $20,000. First Wave is going to add the share-based compensation expense to net income because it's a non-cash expense. The increase in the deferred tax asset and the related reduction in income tax expense increase net income. Although the negative income tax expense increases net income, it does not increase cash. Therefore, it should be deducted. Subsequently, if Ann Johnson exercises her options, First Wave is going to report cash provided by exercise of stock options, quote unquote, in the financing section of the statement of cash flows. Okay. Unusual and infrequent items. Number 1, the company should report either as investing activities or as financing activities cash flows from unusual and infrequent transactions and other events whose effects are included in net income, but which are not related to operations. All right, let's take a look at an illustration here of unusual and infrequent items. Evergreen had land with a carrying value of $200,000, which was condemned by the state of Maine for a highway project. The condemnation proceeds received were $205,000, resulting in a gain of $5,000 less $2,000 of taxes. How would Evergreen report the proceeds from land condemnation in the statement of cash flows? Well, when we look at the solution, the company would deduct the $5,000 gain from net income in operating activities section. It would report $205,000 cash inflow from the condemnation as an investing activities. And here in the cash flow from investing activities, we'd find condemnation of land for $205,000. Note that Evergreen handles the gain at its gross amount, not net of tax. The company reports the cash received in the condemnation as an investing activity at $205,000 $40,000, also exclusive of the tax effect. All right, now accounts receivable balances for using Redmark Company to illustrate. Up to this point, we've assumed no allowance for doubtful accounts, a contra asset, as I'm sure you know, to offset accounts receivable. However, if a company needs an allowance for doubtful accounts, how does that allowance affect the company's determination of net cash flow from operating activities? Well, we're going to assume that Redmark Company reports net income of $40,000. Here's its accounts receivable, its allowance for doubtful or uncollectible accounts, and accounts receivable net. And here are the changes in the comparative balance sheet item. Okay. So what we would show is the $40,000 in cash flows from operating activities. We would show the net income here, $40,000, given in the problem here. And we would show adjustments to reconcile that net income with the increase in accounts receivable here for $15,000 and the increase in the allowance for doubtful accounts as an addition to the cash. So the net cash would be $9,000 for that. And as I go back, here are the increases here and here. Okay. The increase in the allowance for doubtful account balance results from a charge to bad debts expense for the year. Because the bad debt expense is a non-cash charge, a company must add it back to net income in arriving at net cash flow from operating activities. Okay, now the net approach to the allowance for doubtful accounts. Instead of separately analyzing the allowance account, a shortcut approach is to net the allowance balance against the receivable balance and compare the change in accounts receivable. So as we show here, here's the net of $9,000. And you'll remember here, it was $9,000. We can simply subtract that $9,000 here from the $40,000 to get to $31,000. Very similar, exactly, I should say, the same as we did it in the prior slide. This shortcut procedure works also if the change in the allowance account results from a write-off of accounts receivable. That reduces both the accounts receivable and the allowance for doubtful accounts, and no effect on cash flows occurs. Because of its simplicity, use the net approach for your homework assignments. Okay. Now, if using the direct method, a company should not net the allowance for doubtful accounts against accounts receivable. We are going to assume that Redmark's company's net income of $40,000 consists of the following. Here's our revenues and our expenses and our net income of $40,000. So what we're going to do then is we have net cash received from our customers of $80,000. We paid salaries, we paid utilities, and that was $54,000, resulting in net cash provided from operating activities. And as you see, we are moving forward here from this income statement to this income statement. Our cash received from customers, now we're looking at the direct method, not the indirect method any longer. And that is the net cash provided by operating activities is $31,000. And you can see it's the same as if we did it the indirect method. An added complication develops when a company writes off accounts receivable. Simply adjusting sales for the change in accounts receivable will not provide the proper amount of cash sales. The reason is that the write-off of accounts receivable is not a cash collection. Thus, an additional adjustment is necessary. Okay, now other working capital changes. Some changes in working capital, although they affect cash, do not affect net income. 1. The purchase of short-term available for sale securities. Number 2, the issuance of short-term non-trade notes payable for cash. And 3, cash dividend payable. So if we look at an illustration of that, here's our short-term available for sale debt securities, AFS abbreviated. A cash purchase of $50,000 of short-term AFS debt securities has no impact on net income, but it decreases cash by $50,000. We're going to report on the statement of cash flows as a cash outflow in the investing activities section. Here, short-term non-trade note payable, a current liability. Here, we're going to issue a $10,000 short-term note payable for cash. There's no impact on net income, but it increases cash by $10,000. We're going to report it as a cash inflow of $10,000 in the financing activities section. And number 3 here, a cash dividend payable is a current liability. And here we've declared a $30,000 cash dividend. It has no impact on net income. It has no impact on cash. It's not reported on the statement of cash flows because the dividend is declared but unpaid. Note that once the dividend is paid in cash, it's going to be reported as a cash outflow of $30,000 in the financing activities section. Okay, let's take a look at a net loss with a positive cash flow. Here, the Juarez industry has a net loss of $50,000. The only adjustments for the operating activities sections are depreciation expense of $55,000 and amortization of patents of $5,000. The question is, how would you present the operating activities section of the statement of cash flows for Juarez? If we look at the solution, after making adjustments for non-cash expense items, Juarez is going to report a positive cash flow from operations as follows. Here's their net loss given in the problem, and the adjustments to reconcile net income to net cash provided by operating activities. We're going to add back the depreciation of plant assets, $55,000 here, and as well the amortization of patents for $5,000. That total of $60,000 will offset that net loss of $50,000, and the net result will be the net cash provided by operating activities of $10,000. That looks like a good place for us to end this video, and when we return, we'll take a look at a net loss with a negative cash flow. Until that time, bye for now.